Hi everyone. It's not a secret that the dollar enjoys the status of reserve currency of the world, and this, coupled with the dominance of the US banking system in accordance with the full autonomy over the SWIFT payments network, has solidified not only the US standing but the dollar standing all over the world as well. In fact, in spite of the fact that the economic scenario all over the world is looming at the edge of recession, the dollar has still been appreciating, leaving the other major currencies such as pound, yen, euro, as well as the Indian rupee in the dust. According to a survey conducted by the World Gold Council, 80% of the 57 central banks surveyed are already in preparations to expand their gold reserves owing to the economic and geopolitical power shifts taking place all over the world today. Not only this, 42% of respondents in the same survey expect the dollar reserves to decline drastically all over the world in the next 5 years, since every year confidence in dollar as a reserve currency is dwindling more and more. And all this has ultimately made it imperative that the economies and their central banks shall look to diversify their reserves away from the dollar to other assets or currencies like the euro, renminbi or gold. And that, ladies and gentlemen, is what we are going to discuss in depth today. The phenomenon known as de-dollarization and how the US drove itself to de-dollarization. To start off, before diving into how de-dollarization is actually being put to action across the globe and how it's impacting the economies so adopting it, as well as the resulting repercussions ensuing for the dollar, first, let's ask the basic question that why de-dollarization is so actively being pursued and what is so wrong with the current dollar-based status quo. Well, in order to understand this, first let's try to understand that why do nations of the world accept the dollar as the international medium of exchange in the first place. So let's start off with our chapter 1, the background and the fractures. Alright, let's trace back to the post-World War II era. You see, as the World War II ended, a new era dawned upon the world, an era in which European countries who were devastated by the repercussions of the war had been grasping for aids to help their economies and rebuild their nations. An era which saw the rise of two superpowers, the Soviet Union and the United States. By this time, the UK national debt had reached more than 250% of the GDP, which by the way was the worst economic state for the nation in its long-standing colonial history. However, the United States, on the other hand, at the same time was manufacturing more than 50% of the total goods produced in the world and held 2/3 of the total gold reserves of the world. And this is corroborated by the fact that the GDP per capita for the US saw an extreme uptake during this period and was far more than the war-stricken countries of Europe. Also, for comparison, if you look at this chart where the US balance of trade is firmly stable during the post-war periods, the UK balance of trade ran in huge negative figures, thus pulling the nation to economic jeopardy. The world by now had recognized the supremacy of the United States as the economic powerhouse, and thus US took it upon itself to rebuild the war-torn nations and their economies. As a result, the US came up with the Marshall Plan, under which the US leaders created the post-war European Recovery Plan that pumped more than $13 billion into rebuilding Western Europe. So if you analyze the situation here, the US literally pumped dollars into the development of these nations, which obviously increased the dollar liquidity, thereby evolving the accumulated reserves. And this further elevated by the fact that the US pumped dollars into Europe. It simultaneously also created new markets to export American goods and consume American products, such as the US airlines like Pan Am, or stays in American-run hotels in Europe like the Hilton chain, and in the process elevating the US economy as well as the dollar's relevance. By the way, while all this was happening, the US President Franklin D. Roosevelt was courting the Saudi King Abdul Aziz ibn Saud in the Suez Canal, which ultimately led to the signing of Mutual Defense Assistance Agreement, according to which the US was to provide Saudi Arabia with arms and trainings of Saudi military to fend off the Soviet Union. But the Americans in this deal got the Saudis to agree to sell their oil only in dollars, which today is known as petrodollars, which increased the dollar's prowess by leaps and bounds and has vested in US the power of applying sanctions, as evident from the case of Russia today. Thus, ladies and gentlemen, all this has totally engraved the US dollar as the most powerful currency as well as true reserve currency of the world. But on the other hand, as the saying goes, too much of everything is bad. The dollar's shine is fading and other nations are stepping up. But I'm getting ahead of myself. Alright, on to chapter 2, the hidden weapon. So now that we have discussed the dollar and its superpower, point to note here is that the dollar's strong relevance and presence as the medium of exchange is not only and cannot be the only reason why de-dollarization is picking up the pace, and that's because the US has another very important piece of weaponry in its arsenal: the US control over monetary policy globally. And this is something which cannot be encountered at this stage, especially by countries like India. So let's try to understand this in as simple terms as we can. When we say US has control over monetary policy, what we actually want to know is that why is it that whenever Federal Reserve, which is US's equivalent of RBI, hikes interest rates, other countries need to follow and hike their central bank's interest rates as well. So let's assume that Mr. Elon Tusk is an investor who has invested in Indian market in the form of Indian treasuries, which are basically bonds issued by the government. And then there's Mr. Jeff Bezos, who has invested in the equity markets in India. So as per status quo, Mr. Tusk is receiving 4.5% yield on his bond in India and 4% yield on his bond in the US. Since Mr. Tusk is getting better yield on Indian bonds, he is invested in the Indian market as a foreign portfolio investor. But as soon as the Fed will hike the interest rates, this actually means that the interest rates on the US Treasury bonds will increase. And when a bond's interest rates rise, its yield also increases. So earlier when Mr. Tusk was getting a yield of 4% on the US bonds, post the Fed hike, his bond yields rise to 5%. Now Mr. Tusk will sell off his Indian bond and move his money back to the US market since he is getting better bond yield in his own country. And as soon as Mr. Tusk makes his move, as Mr. Bezos knows that the rupee value will depreciate because the bond investors have moved back to the US, this weaker rupee will generate lesser returns for him in the equity market, which will further motivate him to move to the US as well and invest there instead. And in case you are wondering, yes, the US has had a lot of leverage as foreign portfolio investor, since its investments in Indian markets are more than the combined investments of the next 4 portfolio investors. So in order to avoid these situations and keep the domestic currency strong when the Fed hikes interest rates, RBI will either have to hike interest rates so that they can close the gap between the interest rates to maintain same balance as before, or it can let the rupee depreciate without hiking interest rates and protect the currency through the sale of dollar reserves, which will reduce the demand of the dollars in the international market, thus depreciating dollar more. On to chapter 3, the titular de-dollarization. Alright, I think we have a fair bit idea of why nations fear the dollar is getting too strong, and as a result of which the de-dollarization phenomenon has picked up. This de-dollarization has been doing the circles for quite some time now. But how exactly? Let's break down first of all with the case of Egypt. People, in case you missed our video on how dollar appreciation affects the economies all over the world, I will attach a link in the description below for your reference to get a more vivid and comprehensive picture of what's happening with the debt scenario of countries like Egypt. Okay, the developing nations like Egypt have been suffering greatly because of the debt it has taken from US-driven development institutions such as IMF. If you see here, the dollar-denominated debt has almost doubled in a matter of 5 years, all because of the country has been suffering at the cost of paying off this debt, and that too in a fragile economic landscape. So Cairo, as a solution, started issuing yuan-denominated debt, which is a fancy word for saying they issued bonds to raise funds in the Chinese bond market. To add to this, the Chinese offered Cairo a cheaper deal to borrow in yuan than to borrow in dollars and then convert to yuan. This settlement was also driven by the fact that Egypt imports large amounts of goods and services from China, especially since the development of Egypt's new administrative capital, which has ultimately made it easy for Egypt to gain access to yuan. So in a nutshell, the helpless economic situation Cairo has been in left it no option but to present a defiance against the dollar empire, and this indirectly makes it now a member of the de-dollarization club. Now China, like in the case of Egypt, has been on the forefront making the most of the de-dollarization wave, and the biggest move in this respect has been to change America's equation with the Saudis. As we discussed in our story earlier, Americans have been the convener of the power vested in them by the oil trade index. But this balance is shifting rapidly, which is evident from the fact that in 2020, Saudi Arabia exported $95.7 billion worth of oil, of which China accounted for $24.7 billion in imports, while America's share stood at a meager $6.59 billion. Hence, the petro-yuan oil trade has been the talk of the town, which is also backed up by China's investment in Saudi Arabia via its Belt and Road Initiative, and has resulted in an inflow of $43.47 billion in 2021. All this, along with the fact that a global debt crisis is driving poor economies to lose faith in the US dollar, has changed the course of the trade more in favor of China now, thereby giving the necessary push to de-dollarization, which it has been looking for. Alright, let's take a second so that I can pose a question here. We know now that China is a de-dollarization proponent. So do we trade with them in yuan or rupee? Well, we don't. We trade with China in dollars only. That's dumb, right? Why are we not trading with China in yuan or rupee? Let's answer this with a practical example. The biggest items of India's imports from China are electric and electronic goods. They are the springboard for enlarging trade between India and China. Diagonally, China is the biggest trading partner of Vietnam. The biggest items of Vietnam's export to and import from China are electronic and electric items. In the past few years, Vietnam has emerged a major exporter of electric and electronic goods to India. It was the second biggest exporter of electric and electronic goods to India in 2021 after China. Given these dimensional changes in trade structures, the yuan can reap the growing potential to be a traded currency between Vietnam and India. But since it is not a global currency yet, so trading with Vietnam in dollars makes more sense for us. Plus, we have all that history with China, so you get the picture, right? Lest we say more. Alright, coming back to talk about China's in-house initiatives towards de-dollarization. China launched a cross-border interbank payment system for renminbi clearance and settlement services in 2015. The main objective is to promote the greater use of the renminbi whilst also serving as an alternate messaging service to the SWIFT, thereby reducing the risk of transaction exposure to the US and in turn rendering the US sanctions useless. Apart from this, a very discrete piece of equipment which has been in the use for quite some time and has been evolving to greater heights is the UnionPay Independent Bank Card approved by the People's Bank of China. UnionPay is already the world's second largest card brand with a 32% market share, beating Visa and MasterCard as per a 2020 Nielsen report. Following its proliferation, the card can even be used in India to dispense cash out of the ATM. But its main objective might lie on the same lines as the Chinese apps, which have been banned by the government for all wrong intents and purposes, which are beyond the scope of this discussion. Hence, UnionPay might help China in de-dollarization because of the internationalization of the renminbi via the card, but the card should definitely come with an advisory. Now coming on to Russia and its four-pronged strategy towards de-dollarization in 2014, following the sanctions imposed on it for the annexation of Crimea. First of all, Russia reduced its share of dollar-denominated assets to just 16% in 2021, which is evident from cutting the USD from its 186 billion national wealth fund. Secondly, it reduced its share of trade, which was conducted in dollars by dealing in national currencies in bilateral trade. The USD from Russia's exports has as a result crashed from 95% in 2013 to less than 10% in 2020. Thirdly, Russia also developed a national electronic payment system called MIR in 2015 after numerous payments and services firms banned Russian banks. Now practically all trade and service points including shops, stores, restaurants and even petrol stations now accept payments with MIR cards. And fourth, Russia has also developed its own alternative to the US-led SWIFT system for international payments known as System for Transfer of Financial Messages or SPFS in short. To further expand the reach of this system, in 2019, Russia and Iran connected their financial messaging systems linking banks in both countries through SPFS and CPAM, which is Iran's own alternative to the SWIFT. This was followed further with introduction of SPFS to banks in Eurasian Economic Union, which includes countries like Turkey, who have started using ruble and lira in cross-border payments and settlements, greatly increasing the foundation of de-dollarization initiatives on the international fronts. So to recapitulate, all's not looking good for the dollar, And we still haven't discussed the major de-dollarization coalitions and the efforts which have already bolstered this movement against the dollar. China and Russia's aggressive stance is surely giving a blow to the dollar and its current standing. But as we discussed, the monetary power and the dollar's reverence across the years as a hedging currency as well as a reserve currency is too much to be trampled upon. But one thing is for sure, the geopolitical arena is shifting its landscape at a pretty fast pace, and India will definitely have to pick up the reins as soon as possible. If you like the content, please subscribe to the channel and do not forget to hit that like button below. I'll be back with another such knowledge-filled episode. Until then, mindfulness signing off.